Holy smokers, folks, this ain't no dang jokers. Tesla, my Tesla is the top subject of today's video. Stock got hit very hard today. It was down anywhere between 6 and 7 percentage points here today. We're going to talk in depth about Tesla, the numbers there, my opinions on it. With this move here today, is Tesla a buy now? Is it not a buy? I want to share my perspectives on that. So we'll dive into Tesla. That's going to be the main subject. After that, I got to show you something that definitely scared me in the market today. I'm not sure how many people were even paying attention to this, but I saw that and I was like, oh boy, if that trend continues, we're going to have some trouble here, okay? Some stocks made some very strange moves that I want to show that were suspicious here today, okay? We're going to actually talk about Chef, Oatly, and the Planet in today's video. We don't talk about those stocks too often recently, and I know a lot of people wanted me to share some opinions and perspectives there, so I want to kind of share some thoughts. Some strange dividend moves in some dividend stocks here today, and I want to explain what's going on there. And then Google McDougal, something big happened there here today, and that has ramifications for many other various things. I want to share my opinion. So busy video. I appreciate everybody's being subscribed. Thanks so much for being here. I appreciate y'all. I've been kind of dormant for a few days, took a few days off and just kind of recharged my batteries and whatnot. So yeah, I appreciate everybody still being around. If you're looking to apply to join my private stock group, private wealth group, learn directly from me, that will be the pinned comment down there to apply to join us there. So Tesla obviously got hit here today pretty hard, right? 6% plus move down here today, right? Now it's interesting to see. It's very interesting to see like the different headlines out there. Look at this one. Tesla posts record quarterly deliveries after price cuts. It's amazing. It sounds great, right? Then you read this headline. Tesla shares drop after deliveries report raises investor concerns that more price cuts are coming. So it's just, it shows what makes a market, right? You can hear it from a very positive angle on those numbers. You can hear it from a very negative angle, right? And it just depends on, how you want to look at it. It really, if you look at it the bullish side, you're looking at more of this perspective. If you're looking more bearish side, you're looking at this perspective. Yeah. The numbers, okay? So 440,000 was a production number. Delivers is 422,000, okay? Now, first thing the bears will point at for something like this, okay, is they're going to say, uh-oh, we got a problem here. Look at the production number was 18,000 vehicles more roughly than deliveries. Okay, so that's something the bears will say. Now, in my opinion, production numbers should always slightly outstrip deliveries numbers, right? And so it sounds like a big number, let's say 18,000 vehicles, but when you break it down on a percentage basis, it's actually a very, very small amount. And like I said, there should almost always be a teeny bit more production in a quarter than deliveries, okay? Now, if we back this up, what did they do last year in the same quarter? Their production this past year, or last year, for the same quarter, 305,000 and 310,000 deliveries, right? And so look at that. They just basically went up well over 100,000 vehicles year over year. That's extraordinary. And the reason this is so big, there's actually several reasons, but one is we know people buy autos on loans mostly, right? And so, especially when it comes to new autos and especially the price points that Tesla's talking about, right? It's interest rates, right? And so at the end of the day, you look at the interest rates for this quarter we were just in, we're in the sixes for an average, let's say, interest rate on a new car loan. Versus at this same time last year, we were in the 3s and low 4s, right? So think about that for a moment. The interest rate environment has gotten vastly worse for people this year buying new Teslas versus last year, and yet the company still came in with well over 100,000 more vehicles produced and delivered than they did in the same quarter last year. That's pretty impressive. But not only that, if we go ahead and take a look at consumer sentiment, right? If there was a situation where you'd say, hey, maybe consumers are feeling a lot better. Maybe they're doing a lot better than this quarter last year. So that's why Tesla sold a lot more vehicles and produced a lot more vehicles. The truth is, there hasn't been any significant difference in consumer sentiment in Q1 of 2022 for Tesla versus Q1 of 2023 for Tesla. There's no major difference at all. And not only that, you think about these numbers Tesla just put up. And remember, over this past year, we've been around the lowest consumer sentiment numbers we've ever seen in history, right? And so think about these record numbers Tesla's putting up in actually a horrible environment considering consumer sentiment and considering like interest rates have been skyrocketing, right? So if you think about a big ticket purchase like buying a Tesla is, right? You need to be confident to make that purchase, right? But not only that, you need to have the money to do it. And with interest rates being so high and consumer sentiment being so low, it's actually, I would call it a miracle that Tesla's putting up these sorts of numbers. And you have to think to yourself, what if we were in an environment right now where interest rates were, let's say, about where they were last year? and if consumer sentiment was in a lot better place than it's been in this past year. What would Tesla's numbers have been in a quarter like that, right? Would they have produced 500,000 vehicles, 550,000? These are some of the things I consider and I think about when I think about something like this, right? Now, this is even more important than everything I just showed you here, okay? This is why this is even more important. Check this out. This is over the last number of years in the same quarter, right? And remember, they delivered, produced well over 420,000 vehicles, right? Check out 2020. 88,000, 63,000 in 2019, 30,000 in 2018, 2017 was 25,000, 14,000, right? So, I mean, literally, if you add up all those numbers together, you're still not even remotely close to the 420 number. I mean, heck, you could add up all these numbers in the past years, and you're still likely not even going to be at the 420 number. Isn't that incredible? So you see, this is why it's so important to have a long-term perspective on these things and not get so flustered and caught up into the short-term stuff that Wall Street gets caught up into all these short-term things. Because when you really just take a step back and you take a, I don't know, let's call it a 35,000-foot view, right? You really realize how historically amazing Tesla's doing right now as a public company when you can consider you can add up all these numbers together and still not get to the number they just produced in all those past years. That's absolutely shockingly incredible, okay? This company is executing on all levels. Now, what are they talking about from the bearish side, right? Many investors believe that Tesla's recent price cuts reflect a structural cost advantage that will enable it to pressure rivals and capture outsized volume and dominate the EV market, wrote Tony, who's an analyst at Bernstein. We maintain that price cuts have and will undermine industry profitability, including Tesla's, okay, but that incumbents are deep-pocketed and not likely to back down. Interesting. Bernstein has a $150 price target on the stock, well below the current price of $100-something, right? $193 or whatever. The key question for investors is what might margins be amid significant price cuts but improving commodity costs? That is one of the things. Commodities are coming back in line, right? So that's healthy for the company. But, you know, it cracks me up because what we heard in the conference call is Tesla, basically, based upon what their CFO said, based upon what Elon Musk is basically alluding to, they're not going to see their margins crash in any meaningful way whatsoever, to be honest. And so this guy's worried about something that Tesla's not showing any indication of major worries about. Based upon what I heard on the conference call, it sounds like Tesla margins could get hit a little bit, but the key word is a little bit. It doesn't sound like this is an off-the-cliff type scenario whatsoever, okay? And if you look at Tesla's margins over time, this is shockingly amazing how well their margins are, right? These are trailing 12-month gross margins. And you don't have to be a stock market expert to be able to see that gross margin over the past number of years, right? Check out their operating margin and where their operating margin was a few years ago versus where their operating margin's at now, right? And look at what arguably is the most important margin of all, okay? Their trailing 12-month net margin. And look at that, baby. It's up, up, and away. So if there's one thing I think it's hard to doubt Tesla on is actually margins. This is one of the most amazing stories I've ever seen of margins across the board getting in such a incredible place and doing it rapidly. It's not like this has happened over a 10-year span. It's really they made this progress over the last 4 years where it's like their margins were, let's just call it bad. And now they're getting, pretty close to industry-leading margins, if not industry-leading margins now at this point in time. And think about where their margins could be 3 years from now, 5 years from now, 7 years from now. Remember, Tesla's shown us nothing but getting smarter and smarter and smarter about all the decisions they make, everything that goes into their vehicles, right? So you got to keep in mind, the margins you're seeing today could actually pale in comparison compared to what the margins could be for Tesla 3 years out, 4 years out, 5 years out from now, okay? And that's something I think that's not thought enough about, in my opinion, whatsoever from Wall Street. So his bearish thought there, I think it's something everybody should take into account. I just think, it's very hard to doubt a company that has been doing this with their margins over time here, essentially, okay? Now, he talks about the competition. This is actually a 3-year-old chart, and this should be shocking to everybody watching this video right now, okay? Because I can tell you for almost all the auto manufacturers, it's actually gotten worse for them, and Tesla's gotten better. Tesla's in a position now where if they want to pay off all their debt this year, if they want to do that, they could do that. I'm not saying they're going to do that, but literally, if they want to pay off their last remaining bits of debt here, they could do that literally this year and be debt-free, which is absolutely insane to think about for a company like Tesla, right? But if you look at the automotive industry in general, right? I mean, these companies hold extraordinary amounts of debt. And I can tell you, right now is not a good time to be a debt-laden company. Right now, you want to be cash heavy and debt low, and especially given the interest rate environment we're in, which who knows how much longer interest rates will be in a higher environment. It could be a few more months, could be a few more years. You never know in this situation, right? But the bottom line is, you don't want to be a company that's debt loaded with very little cash. Not right now, okay? So I think that chart's very, very important there, right? Now, with me, as a Tesla shareholder and somebody who's been a shareholder of this company for a long time, did the results that I just saw there, did they make me want to buy the stock or sell the stock, okay? I can tell you, personally, if anything, those results made me want to buy the stock more. Abso-dang-lutely, okay? I can tell you, what I'm seeing with this company, the execution in this environment, this is a horrible environment to sell high-ticket anything, okay? I don't care if you're talking about homes, cars, anything like that, furniture. It's not a good time period to be selling those sorts of items, okay? And with consumer confidence at low, interest rates, the highest we've basically seen in the past 15 plus years, the highest Fed funds rate we've seen in 15 plus years, right? The Fed trying to actively work against the economy for over a year now straight. When you think about that, it's not an ideal situation for a company like Tesla. And so the fact that they put up these sorts of numbers just shows me more that I should be a buyer of this stock rather than just a holder of this stock, to be quite frank. And so, don't be surprised if I end up buying some more Tesla shares over these next few months, because I'm just looking at it, I'm like, this company's just, their execution is, if I had to view the top, let's say if I had to list off the top 10 companies that have executed over the last 3 years, Tesla's in that top 10 easily. They're probably even in the top 5, to be honest. So absolutely extraordinary from Tesla. If anything, while Wall Street was selling that stock, if anything, I was viewing it more as a bullish, kind of situation there. Okay. Now, that's my opinion on Tesla. By the way, if you guys have an opinion on Tesla, feel free to share it in the comment section. I love to read through kind of your guys' opinions on the numbers, positive, negative, anything you got to share. Love to read through that. Okay. Now, something definitely scared me in the market here today, and I saw this and I was like, if this trend continues, we're definitely going to have some problems in the market in a few months from now. Okay, if this keeps up. Okay, and what happened here today was essentially commodities went up substantially. Okay, this is a commodity index in general, and if you want to keep track of basically how commodities are trading instead of keeping track of them all individually, you can just add this. Okay, GSG, and this index essentially was up 2.68% here today, so it was a pretty big move. Okay, and now the commodity index in general is actually positive on the year now, okay? Not something we want to see. We want to see commodities continue to go down this year, if anything, not up, okay? Not something we want to see whatsoever. Now, why did commodities go up so much? The reason is oil skyrocketed today, okay? It made an over 6% move here today. And I can tell you, when oil makes a 6% plus move, it's gonna send commodities up, okay? Now, this is troubling because now we're at a position where oil is now up 4% for the year, right? And it's potentially going to new highs. We'll see what happens here. OPEC obviously made a move there. And we don't want to see a situation where gas prices are as expensive in this summer as they were last summer. It is not something we want to see. On a national average recently, we've been about 50 cents to 75 cents a gallon cheaper than we were last year. That's great. We want to see that continue through the summer. So, let's keep an eye on this. This is something troubling I'm seeing. And I'll be honest, I was in Arizona recently, and I was shocked by the gas prices I saw out in Arizona. I always remember Arizona was fairly cheap market for gas, and my gosh, it is not anymore. I was looking at some of these gas stations. It was like $4.50 a gallon in Arizona. It's like, my gosh, man, things have changed in a pretty substantial way, okay? Now, Meta, another one, okay? Another move up for Meta here today. This stock, you can't get in its way right now, okay? The NASDAQ was even down today, and Meta still was up here today. I mean, the stock's extraordinary right now. It's just showing strength on strength on strength on strength. It just seems like there's no incentive for any investors of Meta to sell the stock. It just seems like there's more and more folks that want to buy this stock on Wall Street that understand, like, this company's still undervalued, and they're going to put up insane net income growth over this next 24 to 36 months. It's going to be extraordinary, the net income growth this company has, okay? Especially starting in the summertime of this year, right? Because by that time, they should be done all the employee layoffs and all those one-time costs. And so wait to see the EPS and net income numbers starting in the summertime. Oh my gosh, okay? And then going for about another 24 months, if not past that, the net income growth will be extraordinary for this company. And so they just continue to pile on. For us that are long this stock, there's literally zero incentive for us to cash out the shares. Zero incentive, okay? Speaking about zero incentive to cash out, ELF just continues to hit a new high after a new high after a new high. Absolutely extraordinary, man. ELF and Meta are two of the strongest stocks in the market right now. Those two companies are just insane, man. It seems like every day I open Fidelity account, I mean, those two stocks are up. It's just extraordinary right now, okay? Now, talk about a few of the smaller caps. Oatly, Chef, Planet here, okay? So Oatly's obviously having a really good year. The stock's up about 27% year to date. And I think the real reason this one's showing strength is basically based upon many of the various moves they made. It looks like they're going to be in a great capital position now at this point in time. So there's no like fear around like, oh, could they go under or something like that. So there's that component. Also, it looks like they're just strategically going to run their business a lot better over this next several years than they ran over the past several years. And it looks like their margins are already starting to show increases, but their margins should continue to show increases quarter after quarter after quarter. And if their margins continue to trend the way they're going to trend, and they bring down costs of running the business, that profitability should be there. And those losses that were gargantuan, you saw this company taking insane losses in 2022. Those should go to minuscule losses over the course of this year. And there's definitely a potential, in my opinion, where they start putting up profitable quarter after profitable quarter, actually starting as early as next year and just being a profitable company from there on in, okay? So that's I think what's going on there with Oatly and why the stock has shown such strength this year and obviously outperforming the market, okay? The Chef really, over the past month, has made its big move. And a lot of people are looking at this and I'm like, isn't up another 10% today? It's up 21% in the past month. Like, what's going on with the stock, okay? So my opinion in regards to the Chef, okay, is I think the part was a lot of people like a breath of fresh air, the fact that they haven't gone under, okay? I think that. I think also Sam Galletti talking about profitability coming way sooner than a lot of folks expected. I think that's a breath of fresh air. And I think there's a risk appetite for a stock like this, right? Because if they can just make it through to the other side, there is potential big upside. It's a huge risk, right? But I think a lot of people are almost looking at Tattooed Chef as like a call option play, right? Where it's like, yeah, they could go under, like if they can't, raise capital somehow, they can't figure it out, right? But if they can just make it through this year, the upside on the other side, right, is really, really significant. And so that's what I think is going on with the Chef. I think a lot of people are just looking at it as a call option play and, kind of doing that sort of thing. Obviously, I have not bought this stock in a long time. And I mean, it's been a long, long time. I'm just a holder of the stock and just, along for the ride, essentially, right? It's been a vicious ride. They blew through, almost all their money. This company had almost $200 million at the peak. I mean, it was ridiculous. They blew through it all in a matter of two and a half years. Insane. And now they put themselves in a really bad financial situation. But if they can make it through and they can actually get the profitability like Sam's talking about, then the upside is crazy there. And so I think that's what people are doing with this stock. They're just treating it like as a call option, man. That's all that's going on there in my personal opinion from kind of that standpoint. And the market cap now at this point is so small that it's like all it takes is, a few people with decent money to, put some money in that stock and kind of treat it like a call option play, and you can get a big move there. And obviously here today made a big move. So it's probably going to continue to trade like a call option, okay? The Planet's a very different situation, right? And this stock's about 20% year to date. First off, I still like the Planet very much, okay? And there's a big difference between the Planet and somebody like the Chef, right? Where the Chef blew through all their money. Planet's done a phenomenal job as far as their management team of really watching the money, okay? And spending every dollar, like watching every penny they spend on this business. And I got to say, Bob and Larry have done a phenomenal job really keeping that capital close and not just blowing it, unfortunately, like the Chef has done, right? And so the Planet's actually in a great capital position. I would make an argument that they're in the best capital position of any company in the world that is in the MJ space. Almost every single MJ company has been going under or could be potentially close to going under this year. And the Planet, it's not like that at all. They're loaded with cash. For how small this company is, they're loaded with cash. Them and Avant are the best run MJ companies by a mile and a half. And it's not even close. No one's even in their same league, in my personal opinion, okay? And so somebody like the Planet, I think I wouldn't be surprised if this stock's double the price at this time next year, to be quite frank. I think they're going to start putting up really good numbers actually as soon as next quarter. That's my personal opinion on that. I think Vegas is going to continue to show strength regardless of kind of what's going on in the economy. It's just every time I go down the Strip, it's busy as heck down there. The Planet location is the busiest I've seen it since maybe summer of 2021. I mean, I went by the location about 2 weeks ago, and it was extraordinary how busy that location was. It was unbelievable, really. And so I would bet, I think there's a high probability they're going to show actually really nice revenue growth starting next quarter, and I think there'll be momentum, and I wouldn't be surprised if the stocks double or triple up the price in a year from now, essentially, okay? Am I buying the Planet? Absolutely not. I'm holding the stock right now. In terms of all these small caps, I put them all in the same category. When they hit profitability, that's when I'll buy more shares. I obviously put way too much money in all those risky small caps in 2021 and the beginning part of 2022, right? And so now I'm just holding what I got in all these different stocks, and it's going to be what it's going to be. And when they can show sustainable profitability again, that's when I'll step back in and I'll be more of a buyer of these sorts of companies. But they got to prove it now at this point in time, okay? So that's why I'm just a holder of those. But anyways, that's my opinion on that one, okay? Now, a lot of these dividend stocks made big moves here today, right? Foot Locker up over 4% here today. You saw WBA up 2.5% here today. JWN was up nicely. Pfizer up nicely. When it comes to these dividend stocks, okay, money's going to have to flood back into these babies, okay? A lot of people sold a lot of dividend stocks over the past 9 months, okay? And they didn't just sell them because of worries about the economy and whatnot, because actually a lot of those different dividend companies are just stable cash flow companies regardless of the economy. But what we're seeing is a lot of these companies bring down costs in their business models and focus on bringing down costs over this next few months, the next few quarters. And so these companies will actually emerge likely much more profitable than in the past. But not just that. So much money has flooded to treasuries and other places. If you're talking about any chance that treasuries are going to start yielding less, right, which they've already started that, in other places, let's say savings accounts, CD accounts, start yielding less and less and less, money is going to flood back into a lot of these dividend stocks, right, which is going to put some pretty incredible buying momentum on these stocks over the next 9 to 12 months, assuming interest rates start going down. Now, if you can get just more and more and more on savings accounts, CD accounts, they'll continue to be a headwind for a lot of these dividend stocks. I'm not so convinced that's going to be the situation, okay? And so just do keep in mind, there's a lot of money in other places right now that's got yield that could come back over these dividend stocks, the Pfizers, the Foot Lockers, the WBAs, and all these other ones that just, are consistent cash flow companies that like to pay out the big dividends, okay? Now, I don't know if you guys saw this top news. Google McDougal is going to cut down on employee laptops and services and staplers and all this stuff to save money, right? And they already announced they're doing big employee cuts, right? In the story with Google McDougal is a story with the stock market in general in 2023, in my opinion. It really started in 2022, right? I think this is just the kind of grand finale year. Every single business out there is watching their costs. Now, that hurts the economy. That hurts spending. That hurts the business climate in the short term. But I can tell you what's going to emerge in 2024, actually got to start this year, but really in 2024 as far as a full year, 2025 and future years, is companies that are in far better, let's call it business models, cost with their business, margins, like everything you're going to see is going to improve quite dramatically in these companies. And I think it's going to make for a nice 5-year run where these companies are going to be able to expand their bottom lines at a much faster clip than their top lines are expanding. Basically meaning if a company has, let's say their revenues go up 10%, or let's say their revenues go up 5%, I believe a lot of these companies' net incomes could go up 8%, 10%, 12%, okay, and far outstrip their revenue growth. And that's something that happened coming out of 2009 because companies in 2008, 2009 did obviously a ton of employee cuts, and obviously they cut costs in their business, and they learned how to run their business much more efficient. And what you saw is unbelievable net income growth from companies from all the way starting in the back half of 2009 all the way through the back half of 2014. And if you see the net income growth of an average company, it was extraordinary during that time. And I think we're going to set up for the back half of 2023 all the way through to about, let's call it 2026, if not 2027, incredible net income growth with companies that's going to far outstrip revenue growth, which is something we haven't really seen in a while. Because if anything, we've been seeing companies have stronger revenue growth than bottom line growth, which is actually usually not a very healthy sign for companies. Always do keep in mind, a healthier sign for companies is a situation where the bottom line outstrips the top line, okay? That's the ideal situation. And so just understand, when you see stuff like this, it hurts short term, but I can tell you this is going to make so many of these public companies, almost all of them, such better companies for the next 4 or 5 years, folks. And for that, it's something to be very bullish about over the next number of years. I appreciate everybody joining me as always. Hope you got good value out of this video. Thanks so much. Thanks for being subscribed. Also, if you're looking to apply to join my private stock group, the private wealth group, and take investing obviously on a much more serious level, check out the pinned comment down there. That will be to apply to join us in there. Much love and have a great day.